Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Hi and welcome to the podcast. I'm David Loughnan and I'm joined with my co-host Col Eccles. How are you, Col?
Good, Dave. Thank you.
Good. Today we're talking about something that, is going on in the market. It's Trump's tariff and really it's affecting a lot of people's superannuation, and there's really enormous amount of fear that goes in when the markets go down. And today we really want to talk about some options, how to potentially handle that and what's on the table. And that can actually also create opportunities as well. How do you find most people react, Col, to the market movement?
Also, what drives markets is fear and greed. And so obviously now there's the fear of the unknown, what's going to happen next. And so the first reaction is to go defensive. You don't want to see your money drop any further. And so you take a defensive position, which can be the wrong thing, because at the end of the day, we don't, whilst people, experts even can have an opinion of where they think things will go, like a good idea where it's going to go, but no one really knows. So it's people, I think now is the wrong time to make rash decisions. Yes, the market's down, 10% for a few days, but to make rash decisions now is probably not the right idea.
Yeah, it's really hard to actually make the right decisions in hindsight. So when you go down a couple of years, we should have done this and we should have done that, and everyone's an expert at the time, and everyone's got an opinion, which I find really interesting. And part of our role as financial planners is really to support our clients through this. And really, they've got four options. And the main one, really what I want to start on today, is the main one, which is really when there's fear in the market, everyone really holds through this period. I think just before we really get stuck into that, I just really want to make it clear that there's no advice in this thing. All the options I'm talking about, please chat to your financial planner, or if you've got some trusted advisors, make sure you get some help before you do anything in these cases, because it can be a very dangerous environment and it can cost people a lot of money in those things. But one of the main ones is really holding the position, because if you're well invested into your risk profile and how the outlook, you've actually taken into account and understand that these things can and do happen, and they're going to happen many times over your lifetime. Do you find most people hold their portfolios?
I think they do with the right education, without coaching, hand holding. It's like Warren Buffett says, you've got to invest in something that you're prepared for it to put to nothing for 10 years. And at the end of the day, again, like you said, it's everyone's individual. It's like whether you've borrowed this money that you've invested, are you going to draw on it the next short term? But generally, if it's something you're not going to need access to in the next few years, it's holding is a good option. And again, it comes to how people, not their comfort level, because everyone's unnerved about what's happening. But like you said before, if you understand the investment, if they're big, strong companies, they always we spoke about in our last episode, I think it was, about the CBA share price. So companies are big, strong companies, and the share price, I think you said before, is it's a valuation at a point in time. But if the company's still strong, why wouldn't you ride it out?
It depends how you look at it, right? Because we know from history that market's always gone higher than the previous high.
Yeah.
Right? That's happened through history.
Yeah.
So that's going to happen again. It's always the question of when, and the market's from probably high to low at the moment around that probably 20% pull down. So we know that over time it's going to go probably most likely up 20% and more. So do you feel it's an opportunity, or do you feel running and hiding under the bed and putting your head under the pillow at times, or putting your head in the sand, is not a bad option for most people?
I think if you look at, like you said, this happens all the time, like the markets go down. And when you look at one thing that the sort of history or the chart shows is that, yes, when markets go down, which they will do, when they're recovered strong, as like you said before, it's like we don't know how long or how far it's going to go down. We don't know when it's going to recover. So if you make that sell now, and then it suddenly goes up, and then you hold, do a window go back in, and before you know it, you bought in high and you sold out, and that's a quick way to lose money.
The actual fear and greed can take us over, and the fear of that this is never going to stop and keep going down, and then the other side, people jump on the train too late when the greedy, they feel that it's really hard to time those moments. Getting into the market over time, especially with superannuation, more specifically, what we're talking about today, is that a lot of money that people are getting money going into their super on an employment basis, and they might be putting some money in there themselves. And also the investments generate over time. So it's actually buying generally every month anyway.
Yeah.
So it's buying at a lower price right now, and in the future, the market will go up. The next one that people have the option to do is really sell the equity side of their position, so the more aggressive share market side of things, and keep their defensive side? What do you think of those types of moves?
Again, it's like we said before, if you sell now and the market goes further, and then how much further does it go? When does it stop? And then when it starts to recover, when's the right time to buy? When's it the dead cat bounce? It has a sort of recovery and drops again. So you don't really know. So I think, again, depending on the person's, like you mentioned super before, if you're young and the money's going to be sitting there for the next 20, 30 years, it's like you question, why would you sell out now? Maybe the fear does drive them and they make that decision, but you've got to question why. What's the rationale behind that?
As a financial planner, most people that we've put into risk profiles, we've actually already made an assumption. If this happens, how would you react?
Yeah.
It's actually in all of our questions. So whether some people might forget that question when we go down the track, but we always ask, if the market fell 20% or fell a lot, when would you sell? Generally, most people in a calm, unemotional state will say, I'll hold that. I won't have any problems, until you get put into that state where obviously having someone on your side helps that not to make poor decisions. So if anyone's looking to sell or need to sell, in my opinion, it's more that you're actually in the wrong risk profile to start with, because you knew this is going to happen, and this will happen many times over. Generally, it happens every 4 years. There's 3 years generally positive and 1 negative, and that's happened over a long period of time. They're coming.
Yeah.
So
I think if like you said, everyone says, oh, if it happened, I wouldn't sell. And then when it happens, like, they feel differently about it. But I think if you then help them, educate them, and really go back and show what history tells us, to try and put them at ease or make them feel a bit easier about it. But then, like you said, if they still feel that strongly about it, then it's like you're really not the risk pro. You're really not, you don't have an appetite for risk as much as you think.
You thought you would. Because it's like they say, until you're punched in the face, you don't know how you're going to respond. And it comes with the share market. I'm uneasy about it. I've got 300 clients with money in the share market, right? It's funny enough, most of my clients have been with me a long time, and they know my sort of tact with it is generally put more money in, buy more. We're buying at a cheaper price now than we were 2 weeks ago.
Well, I got the benefit of the COVID downturn. So a lot of people's been through that, so they get a bit understanding. Like you said, it's that with experience, if you've gone through it once or twice, you've got a bit more comfort about how things should come back.
Comfort in being uncomfortable, I think it's called. I think it's one of those things that, it's difficult to handle when they come along. You know that they're going to come along. And it happens in property markets as well. One of our clients bought a place down in Melbourne, which hasn't had the great sort of 12 months or the last couple of years. And he's down, if he sold it today, about 400,000 on that same house, where he's trying to actually move somewhere else. So it's not just the share markets that do it, the property markets do it. There's got an actual price every day in the share market, where doing the same thing like the property market, when the markets are down, putting your head in the sand and waiting is not a bad option.
A lot of people say that. It's like you say, same as, the property market, but I'm not going to sell, so I don't care. And it's the same shares.
I love that.
If you're not going to sell it, not that you don't care, but it's like, why would you not ride this out?
Because like your net value's down, and it's a bit of a hit to, I was just chatting to one of my clients before that he's got a bit of inheritance come in where he's looking to get money in the market. He goes, it's a great timing for that, but I'm really shitty on the other side of my portfolio. There's actually losing money. You just can't have it all. So overall, getting the money in, and then hopefully over the next period, the markets go up and you're happy all the way around. One of the other things a lot of people have got is too that they've got the opportunity, because the more aggressive side of their risk profiles come down and their more defensive side is build up. They may have opportunities to rebalance within their current risk profile to be a little bit more aggressive. For those people who are pretty comfortable with this arena and adding a little bit more to the equity markets, what do you think of those opportunities?
And I think that's part of the risk profiling. That might be one of the questions, is like, how would you react about selling, and would you put more money into the market? And that gives an idea as well of how I suppose risk averse someone is. But at the moment, it's like you said, it's only been really sharp downturns, but it's only been a couple of days. So it's really, it's like I always say to people, if you put it simply, it's almost like things are on sale. Because if there's those really strong companies fundamentally, that's going to be there for the next 100 years, and suddenly there's a decline in their share price, and all that presents an opportunity to get in. So
it's funny how you actually can turn the conversation around. Someone will ring me up asking for a little bit of comfort around what's going on at the market, and my next question is, we've got some more money to put in. And when you actually change the way you think, it's more like, this is actually a good opportunity to add some money. But most people, especially with their super, are dollar cost averaging, and they are getting more going into their market. So if they actually switch the perception around, actually, I'm buying at these prices as well. So you're bringing your average price down of your cost into the market. And generally, a lot of people, the market fall at this present time is really just wiped out the last 12 months again, which were 20% gain. And the previous year was about the same. So it's like, I haven't lost anything yet, depending on how long you've been investing for. And those cycles are going to come. It's just, if you've actually put a fair chunk of money in, a capital injection, like hundreds of thousands into the market, it can be painful because getting the timing of that right is really difficult. And that sort of brings us down to the last one. So you can actually rebalance your portfolio, increase your risk profile for those crazy people. What do you think about that one?
Yeah, it depends on your time frame and what your goals on that. But yeah, it's definitely, if you think about the buying opportunity, and even Trump said it, I think he said in the weekend, it's a good time to be rich or get rich, I think it is. He's talking, I think, there about how the downturn in the share market presents an opportunity for people to make money. So it's, by all means, if it's within your comfort level and you see this as a buying opportunity, then why wouldn't you?
Yeah, that's it. I've got a client tomorrow that's in investing heavily into the market, and he's quite looking forward to it. But having said that, the market still can go down another 10 or 20%. So it's like, we don't actually know where the bottom of this downturn is until it's over. And that's probably 6 months or 12 months away to look at the hindsight and go, oh, that was the best buying opportunity, or that one, or so forth. Or this might be right in the middle. It's like when the GFC came in 2008, 2009, that went like 18 and 19% 2 years in a row. That was through a recession. So what we're actually, I don't know what you'd call it, what we're in now. We're in Trump era, right? Like, he opens his gob and he's got these tariffs, which are unheard of. And it's just ludicrous what's actually going on. But that's him. And he has got the reins to the US. And he's hopefully he starts dealing his way out of it over the coming weeks, and the markets will get a bit more of a footing. And until they can take into account, will the US go into recession over the next 6 or 12 months, or will other countries be affected massively as well? So it has that, like the markets, if you look at it, whether it's Trump, whether it's a GFC, or whether it's coronavirus, the market recovers from all these events. So right now, with the market being down, there is a good potential to get more riskier, which is really, most people won't do it. And I highly advise against it if you're really worried about money, because this will be extremely uncomfortable. And then you can sort of dollar cost average it into the more aggressive investments as well, for the more risk adverse people or risky people who are actually in high risk profiles and that, so forth. So have you got any sort of final thoughts on this topic?
I think it's obviously, like we mentioned it a bit right at the start, it's the fear and greed, it's the uncertainty. And that's something with people talking about now, this downturn, how much further does it go? Is it a recession? Because that could be long. Is it this, that? So you don't really know. And it's, if you, like, nobody knows what the bottom is. And once it hits bottom, we don't know when it's hit bottom and the recovery is a sustainable one. But I think it's like with anything, if we go back to think about other things like property or cars, is you haven't really lost anything until you actually sell and crystallize that loss. Same as if you've made money on paper, you haven't really made it until you've taken your profit. So I think that's important as well. If you've got time, everything is about time. If you've got time on your side, why would you crystallize the loss now? As long as it's not like it's, I don't use crypto as an example, but that could go from 100 to 0 overnight. So it's not something like that. It's the share market, it's companies selling stuff, owning buildings, etc. So you haven't really, it's a loss on paper. But until you actually sell is when you crystallize that loss, and that's, I think.
Yeah, I think it's really good points. I always talk about it to my clients. It's that I always talk about shares as units. So our superannuation has, let's say, 1,000 units in it today. The value fluctuates, but every month we add another 5 units to it or whatever, and it just keeps getting bigger and bigger, and the value is going to rise and fall. And having the faith and letting the market go through its cycles, because it is not a straight run. There's no such thing as a straight run in investing.
No.
As much as we would like it to be the case. And what you were saying before, really crystallizing losses, I think is really important. It's funny, if you look back 10 years ago, would it matter when you bought into the share market?
No, exactly.
Probably not. And all these things were going on. So it's just a part in time, as uncomfortable is. And as a financial planner, I'm very uncomfortable with the whole scenario. Not actually for my own money. It's fine, which is down. Like it is what it is. And I haven't sold a thing, and I just keep it all.
So the clients react.
It's not so much even for the client's reaction, because I think 99% of them are great. It's just more, I feel bad for them. Do you know what I mean? Because I know how stressful and painful it can be. But when it comes back, everyone's happy and cheerful. So I would just encourage everyone to, just take a deep breath, no matter what happens. If it goes down further or goes up tomorrow, what have you, get some support around you, speak to your advisors if you've got some advisors. and really hanging tough and consider the options that we talked about today. Most people will do nothing. Some will rebalance. Some will go defensive. I think the defensive side of things is, even though it might feel the best way to go, it's probably the most dangerous out of all of them. If you give time and if you've got time on your side and you're in the right risk profile, it will work out for you in the end.
Yeah, and I think it's like, I think it's the last episode, the one before, we talked about planning and timeframes and all of that sort of comes into this conversation as well. And I think what you said before is maybe if someone feel like if this was a really bad time for them in terms of how they handled the market downturn, like one thing settled down and that maybe that's someone that needs to rethink their risk profile.
Yeah, no, I think the amount of money you have invested has a big impact. If you've got a couple 100,000 invested and you're down sort of 10 or 20 grand or 30 grand, it's painful. It's not that painful, but if you've got a couple of million there and you just lost a couple 100 grand, you haven't lost a couple of grand. You just was valued a couple 100 grand. It feels a little bit different. But as you go through the cycles of being a $100,000 investor to $1 million or $2 or $3 million investor, your experience will grow and your understanding of the share market and so forth. And appetite for risk changes as well. Yeah. As painful as these times, I wish we could avoid them, but it actually does create the opportunity. And also that I know over the last few years with the returns in the market, it can't continue that way.
Yeah.
It is what it is, but you just don't know when it's going to pull back. Unfortunately, we don't have the crystal ball. And like my clients say, oh, what did we sell? And I don't know if it's the right time to sell or the right time to buy. All I know is the right time to buy is every month for the next 10 or 20 years, however long you're doing it. And generally that's going to work out pretty good. So for all those people out there, hang tough. Hope this helps and look forward to talking to you again next week.
Thanks, Dave.